Morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, Senior Market Specialist at FXCM, and my email address rshaw@fxcm.com. Today is Thursday, the 17th of March, 2022. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments, and then I'll bring up the commentary disclaimer. Hey Anna, good morning to you. Nice to have you on the webinar as always, and thank you everyone for joining. Let's bring up the commentaries disclaimer. And just our references, FXCM Markets Scope 2.0, cnbc.com and TradingView. And let me bring up TradingView to start. I'll just put that there as sort of my reminder that we'll go to TradingView first, but I think that it's worth just going through the headlines as we usually do. And the CNBC Europe Markets article has a headline: European markets head for flatter open as investors react to Fed hike. And it begins as follows. European stocks are expected to open around the flat line on Thursday as investors react to the US Federal Reserve's first hike in years. Global markets are muted in the wake of the Federal Reserve hiking its benchmark interest rate for the first time since 2018 and signaling 6 more hikes this year. US stock futures were little changed overnight as investors also digested the latest projections from the Fed, which significantly raised its projections for inflation in 2022. The war in Ukraine is also dominating headlines. Reports of progress on ceasefire negotiations helped boost stocks on Wednesday, and after Ukrainian President Volodymyr Zelensky delivered an emotive address to the US Congress, President Joe Biden also approved additional weapons to be sent to Ukraine. Earnings come from Audi, Veolia, Ocado and Deliveroo on Thursday, and the Bank of England announces its latest monetary policy decision. And we're looking at probably a 25 basis point hike there as well. Okay, so what I have here is the US 2-year yield. It's just quite a sensitive treasury instrument that to monetary policy. The shorter the term, the closer we get to Fed involvement. But this is what we call a 2-year note. Let's take a look at the 3-month. I did take a look at the Fed's fund rate here, and it isn't updated yet, which is quite odd. But I think just taking a look at the US 2-year, which seems to be a fairly good one to look at, US 0-2-year. Okay, we can see that there is a spark up here. Where I think we've actually got to concentrate is, I think there's 2 things that we've got to speak about this morning. The first is just a basic time value of money calculation, which we've done many times before, but I think it's just worth reiterating the theory there. I don't believe we need to do it in huge detail, but what we do need to understand is how interest rates are linked to the risk markets. And the way that we do that is just basic time value of money calculations. And we'll just do it as follows. We're just going to do sort of I'm just going to write dividend divided by 1 plus, and instead of writing I for interest, I'm going to write R, and while R, a required rate of return. And I think this is a good way to look at it. And we'll just use 2 years. We'll just use 2 years as sort of a, so we're going to get a dividend in 2 years' time. That's effectively what we're saying. We're not going to go much further than just talking about R, okay? There is one thing I've left out here, which is tremendously important, is, well, you've written this, but what does it equal to? And that's the key. It equals present values, right? That's the whole point. We want to know how the time value of money affects the present value, because we've got to understand what do you expect in terms of market prices. And I think that we must understand that there are, I think, 2 components here which are in flux. 2 components which are in flux, not just one, which again makes the calculations of present values very difficult. So what's the first component? Well, that's the Fed funds rate, okay? And not just the Fed's funds rate, interest rates in general, so repos, everything's going to be, let's call it Fed funds. Everything's going to be affected by the announcement last night, 25 basis points. Now, think about this in terms of yourselves. You are in an environment where interest rates are starting to move up. You as market participants, you have okay, this is the key, you have a required rate of return. In other words, if you guys are going to put money into the market, you're only doing that because you want to earn a return. But if you can start getting higher interest rates in, say, savings accounts, well, that means you're gonna need to at least match that in the financial markets. At least match it. Otherwise, why would you go into the financial markets? You may as well just put it into a savings account. So the idea is that we're getting Fed funds rates, interest rates in general, starting to move up. So your R is going to start moving up. Okay, so that's the one component of R. By the way, this over here would include inflation. Okay, just for simplicity, we'll say this part includes inflation as well. Okay, so we'll just. But the second part is what we call the risk premium, and this is kind of a subjective. This is a subjective component to the required rate of return, because it really depends how risk averse you are compared to how risk seeking, how much of a risk seeker someone else is. If you are particularly averse to risk, you're going to require a higher risk premium. If you don't mind risk that much, you would accept a lower risk premium. For the sake of this discussion, we're going to assume all of us are risk averse, which is a fairly logical statement to make. Now, we know that there are geopolitical escalations and concerns, clearly, and with that comes the economic fallout from that. Well, we require a premium. Okay, so we require a premium, a higher risk premium, as well as the fact that the interest rate component of the required rate of return is starting to increase. So what we can say is, I think that your R, your required rate of return, I think we can safely say it's getting bigger. It's increasing. Okay, it's increasing. So the fact of the matter is, if it's increasing, then the denominator as a whole is increasing. Okay, the denominator is increasing. So let's just put this in sort of just basic mathematical. Let's just put R over here because it's on the denominator side. Here's the dividend here, and here equals present value. Okay, but I'm going to put present value over 1. Okay, I'm going to put present value over 1. So that just kind of helps us make sense. In other words, the R component, this is not right. Sorry, it must be small r. So the small r is what we call inversely, I beg your pardon, inversely related to the present value. Why is it inversely related? Because present value is a numerator, r is a denominator. Okay, so if r increases, given that it's on the other side of the ratio, okay, it's going to put pressure on your present value. In other words, the fact that rates are starting to move up now, okay, is creating headwinds for the present value of risk assets because of the inherent time value of money components to investing. And the fact that there is a conflict going on means that risk premiums have expanded as well. Those may come down as hopefully we head towards a peaceful solution. But at the moment, the fact of the matter is, I think R is in flux. And if R is in flux, present value is going to be in flux. And if present value is in flux, well, and that's the first thing we need to talk about when we are looking at the yield. The next thing that we need to talk about when we're looking at yield is the yield curve. Okay, is the yield curve. So we'll just put this up here. I'm just taking the difference between the 2s and the 10s, and you can see that it is flattening. Okay, it's heading towards 0, and in fact, with yesterday's announcement, clearly the 2s are pushing the spread between the 10s and the 2s down to the point we've only got 20 basis points between them. Okay, so what does that mean for us as investors? So I'm going to take this out. Okay, and I'm going to just put some points here. So point 1, R is creating headwinds because it's in flux. Headwinds, it's in flux. Okay, so that's the first point. The second point is, well, our yield curve. Okay, our yield curve. So let's just call this yield spread. Call this yield spread. Okay, it's starting to flatten. So we kind of had a curve like that, and it's moving like that. It's moving like that. It's moving like that. When it hits 0, it's going to be like that. I'm actually not doing this right at all. Let's do it like this. There, 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 and there. Okay, so this is the huge one when it inverts, because an inversion. Let's just talk about what an inversion means. Okay, so yeah, and Pete's just saw your comment here, Pete. So inflation is massive, right? So inflation. So all of this is so that R component is also being affected by inflation, 100%. Now, so here's the 2s, here's the 10s. Here's the yield on these. Eventually, it looks like it's going to invert. And I just want to examine what does that mean. So we know that the Fed is active on the short-term notes, but it's the market participants that are really influencing the longer-term rates. Of course, we know that there is quantitative easing, but I'm talking, ceteris paribus, without all things being equal, it's the investor's sentiment that influences the longer term yields. Now let's just examine that. Again, put yourself in the shoes of a bond investor. Let's just say you're happy to buy a bond, a 10-year bond. In other words, you're happy to lend the government money for 10 years. In return, you're going to get paid what's called a coupon. Okay, you'll get paid a coupon. So every interest payment, they usually twice a year, I believe, you'll receive an interest, a coupon payment, which is effectively an interest rate payment. And then at the end of the term, assuming it's just a normal structured bond, at the end of the 10 years, you'll get your last coupon payment plus you'll get your initial amount back. Okay, so it's fairly safe. I mean, it's highly unlikely that a 10-year government bond is going to go into default from a from a industrial country. And the idea here is, if you are buying 10-year bonds, effectively the demand for 10-year bonds is there. If the demand for 10-year bonds is there, it puts pressure on yield. Now I'm just going to show you the calculation there. This is not the true calculation. Okay, we need to do a time value of money calculation, but I'm not going to do that. I'm going to calculate something called running yield, which is a very crude way of calculating yield, and it's simply this: annual coupon divided by price. Okay, and again, just to be very clear, it's not taking any time value calculation. So let's just say your annual coupon is 10% on a $100 bond. Well, then your running yield, what's your running yield going to be? It's going to be 10%. Okay. Now, if we are saying that as an investor, we all are buying 10-year, we're all buying 10-year bonds. Well, there's a demand. We're going to push the price up. Coupon doesn't change. Okay, when you buy a bond, in the terms of conditions, it will say we'll pay you 10% on the face value of the bond, right? But bonds are tradable instruments. So if you are still getting a 10% coupon or $10 coupon, but the demand has pushed price up, I'm just going to make it sort of a ridiculous number. Let's just say the demand's there to push it up to $200. Well, right. Well, what's that going to be? That's going to be 5% right there. You can see that the running yield is inversely related to the price. I hope that makes sense. Okay, so the coupon is going to stay constant. When we're calculating the running yield, let's take your annual coupon divided by the price. Price is very much affected by the laws of demand and supply. And once we put that into the formula, we can see that as price has increased, yield has decreased. In this case, an increase in price has doubled, the yield has halved. Okay, so what is the whole point of this? Okay, the whole point of this is that, let's come back here, is that short-term yields are increasing. Okay, short-term yields are increasing, but the long-term yields are not increasing as fast. In fact, our yield curve is flattening. In other words, the yield here, doesn't seem to suggest that there is any real give. There's no real give by the 10-year bond participants. If there was give, if there was give, you should be selling your bond. Selling your bond should push price down. That should push yield up. But if it's pushing yield up, we should get a steeper curve, but we're not. We're getting a flatter curve. So the question is, well, why aren't longer term market participants giving in terms of bonds? Why are they preferring to hold the bonds, the longer term bonds, to the point that the yield curve is flattening? Do you have the question? I hope I'm explaining this okay. So we're getting movement on the short side. This is all Fed or central bank controlled. Okay, we're getting very little movement. We're getting very little movement of the market participants. They're still quite comfortable to hold on to their. They're still quite comfortable to hold on to their bonds, and if they are giving, the rate of change of their selling out of the longer term is not high enough to steepen the curve. It's in fact so slow that we get the flattening of the curve. Now, once we get to zero, the yield curve is going to be completely flat, because the US 10-year minus the US 2-year is going to equal zero. In other words, the 10-year yield and the 2-year yield will be exactly the same. Once we go negative, once we go inverted, okay, that means the 2-year yield's higher than the 10-year yield. That also means then that the market participants are lacking a distinct confidence to move out of the bond market. They would prefer to earn coupon. They prefer to earn coupon, okay, over the 10-year period than to rotate that into a risk type market. You ask, well, why would that be? Why would the market participants be reluctant to move out of their 10-year fixed income position? You understand the question there? Just let me know if I'm explaining this correctly. I know it's sort of a tougher sort of part of the market, but it's very important, because the idea here is, yes, we're getting higher interest rates to control inflation. Okay, that's acting as a tailwind. I beg your pardon, that's acting as a headwind. Okay, I beg your pardon, I don't want to confuse you. Is acting at the increase in R is acting as a headwind. Well, this is point number 2 now. Point number 2 is, okay, flat yield curve. Let's call it flattening yield curve. Lack of confidence to the lack of confidence let's change it. Lack of confidence regarding current. Now this is the key. I'm going to put this in expectations over next 10 years. So unless there is something to change our expectations, okay, unless there's a change, so expectations can change. Expectations are huge. So if expectations change, then the 10-year, there could be money running out of the bond market. But at the moment, as you and I sit here having this conversation, the yield curve is flattening, because there's clearly, and it says here, the market participants, I'm not sure prefer less return. I'm not sure it's prefer less return. I think the way to think of it, Anna, is to say that they have more confidence. They have more confidence in earning that return. In other words, there is less confidence that they're going to earn that type of return, plus the risk premium in the risk markets. So if you've got less confidence because of current expectations, well, that's not a good thing for us. So we've got the R increasing, and we've got a lack of confidence based on current expectations. And that's the type of market we're in at the moment. So that, I mean, let me just see. Okay, thanks, Pete. So, Anna, does that make sense? Does that make sense? So, rather than saying prefer less return, it's more that you prefer the guaranteed return of the bond market over taking the risk, because you are uncertain of earning that R. That R is your required rate of return. Now, that brings us to the to this chart. This is where we are with regards to the DAX. Okay, and I'm starting off with the weekly chart, and I've got the triple moving average as an overlay, so that we have a really good trend following indicator. We don't have to do peak and trough analysis. We can just refer straight away to the moving averages. Well, take a look. There's huge angle and separation, and that is to the downside on the weekly chart. So if we have to say that, if we had to say what kind of trend are we in, just looking at the moving averages, I think we would all agree trend must be down here, because the green is below the orange is below the red, and all three of them are pointing down. Now we go through to our daily chart, and the daily chart here is got a completely different tone to it. Okay, the daily chart here is actually in a neutral type of position, because we don't have the three moving averages. So these are simple moving averages. We don't have the three moving averages in that bearish formation. We've got the moving averages in flux. So we need more from the market. Unfortunately, we need more from the market to prove that the daily is in fact correct. My worry is that this is a bear market rally. Do I know that for sure? Absolutely not. But I do know that if it is a bear market rally, it's going to cause huge pain. So the fact of the matter is that we need more positivity from the trend following indicator, and I would suggest on the daily we would need them to form up bullishly, green above orange, which we've got, but we need orange above red. Okay, and we go through to the weekly. I think that we would need to get, I think, a more neutral reading here. A more neutral reading would be the green at least pushing above the orange. So I think that we just need to be cautious here, in that there are headwinds. And not only are there headwinds, the technicals themselves suggest that we are not quite out of the woods yet. And the idea here is this could be a really good time to start looking for shorting opportunities, assuming that this is a bear market rally. I'm hoping, clearly we're all hoping that it's not a bear market rally. We would hope that, this is a good buying opportunity. It may be a good buying opportunity, but we would need to see, I think, that risk premium shrink. And I would suggest that if this is a good buying opportunity, we don't have to get in at the very bottom. We just have to get in near the bottom. Okay, so patience here, I think, is exceptionally important. Anna just asking, what are the MA intervals? So again, I'll show them to you. Please don't take these as any magic numbers. There's no such thing. I've chosen a 5 for the green. I've chosen a 13 for the orange because they Fibonacci numbers, and I've chosen a 34 for the red. Nothing magical about it. This system I actually learned in our, I guess the Australian Technical Analysts Association had put it into their curriculum because it was used by a true legend in terms of Aussie traders, a lady by the name of Dawn Bolton Smith. She used 5, 10, 15. Okay, so the idea here is her numbers were completely different here, and she was a legend, in the markets there. So don't take this as sort of really magic numbers, but I'm just using 5, 13, and 34. The point it being, okay, that it's more important to see, I think, the general direction and the separation of the triple moving averages. So it's the image that counts. It's very visual. It's a visual image that counts. That's what Anna says. So You can use any, I would suggest you can use any over here that you're comfortable with. There's no, the longer time frames you use, the slower the EMAs are going to move this, the longer the delay, the more accurate the signals are. The shorter, the quicker are going to be the movements, but the more susceptible you'll be to whipsaw signals. So there's a trade-off whichever way you're going to go. But the point here is, and this is where we'll end off, is that there are headwinds, okay, because of R. There's a flattening yield curve. That is, I think, very uncomfortable. And technically speaking, okay, we are still having a weekly bearish formation, even though the daily is looking pretty good. I would suggest that this could be, and if let's just put this in as, let's just do classical charting here. So let me let's use a sort of this the vanilla chart. Let's change this to the DAX. Let's change this to the daily. Forget about the indicators for now, but if you had to take a look at the, if you were a classical chartist, looking for patterns, well, right away, you know, this could be some sort of wedge, maybe, right? Some sort of wedge, okay? Which, if it is a wedge, is going to break to the downside, or an ascending, which is effectively a bearish continuation pattern. We'll have to see how this plays out, but right there's the potential bear market rally, the dead cat bounce, or as we like to say on the webinar, the sucker rally, right? So we want to be very, very careful there. All right. Let me just see here. Pete's written 148. Am I looking? 14.8 is a major level on the weekly. Okay. Let's just see. Okay, so I think what Pete's saying, this is, we're coming into resistance here as well. So if you take a look at the classical charting, not only do we have an ascending wedge or a rising wedge, as Pete says, well, be careful because that's heading into resistance as well. Now, I want to be very, very clear here. We don't know what's going to happen. Nobody knows what's going to happen. I don't know if this is a bear market rally. What I'm suggesting is that there is a probability that it's a bear market rally. The longer term time frame is still down. Okay. Clearly, if it makes something like this, so let's just say it goes like that and like that, but that's a good sign, because then we have the higher trough, higher peak, and then we'll take a look at the weekly again, and hopefully the weekly is getting a bullish cross as well in the EMAs. But right now, I think that caution is certainly warranted. All right, any other questions there, guys? Any other questions? All right, I think we're all good. All right, guys, let's wrap up here. And I might have missed something. Let me just see. Okay, no, we're all good. All right, guys, I'm going to wrap up here, and then you've got my email address, and we'll catch up tomorrow morning. Just to let you guys know, just before you go, Monday is a public holiday here, but I'll remind you guys tomorrow. Thanks very much, guys. Have a great day ahead.